money?
It's interesting because they're the exact same thing, which is finding the appropriate offtake for the projects that are being developed. As we're seeing the sunset of the majority of the utility PPAs, we're seeing that being replaced with either financial offtake or contract for differences with corporate PPAs who have decided internally to have a more aggressive role in finding zero emissions, making their businesses zero emissions. We found it to be a really, on the one hand, it's great because these are new ways to finance solar. On the other, it does create new challenges, new differences versus the way that these projects have been financed historically. A proactive approach to the market coupled with flexibility. The idea of trying to do things the way you did it yesterday will probably put you in a very challenging position. The market has been evolving and it will continue to evolve. What we have seen as the greatest strength for many of our clients and participants in the market has been the ability to adapt to the latest requirements from either a regulatory perspective, political perspective, financial perspective, and making that all work together seamlessly. I think that there is a great opportunity for the next couple of years, but it's also a continuous challenge to find the ways to make solar work in a more dynamic market. So the idea of a PPA really has evolved. Where as I was just talking about here, the contract for differences where you have settlement not directly at the spot of generation, but in a hypothetical hub, is really become more of the norm versus the exception for a lot of the transactions and for a lot of the projects we're seeing coming to market now and also going into 2019. I think that aspect in itself has been unique, and then also getting the appropriately financeable terms from these PPAs. And some of that is making sure the credit is strong, making sure that it's the take or pay aspects are there, or having appropriate shaping on the PPAs. I don't know. They're all important, but I think that we went through a lot of our learning and our growing pains last year, and now it feels like a lot of the contracts that we're seeing for energy purchase are standardized and financeable. So some of the ways that people are doing it are you have a greater variance in your revenue stream. It's not a huge difference, but there is a difference. So the way in which a lot of financing counterparties are getting comfortable with it is through various forms of reserves and guarantees. If you don't have the exact same terms across all of your contracts like you used to in the utility space, what you end up with is financing counterparties that look for different structures that will have to come probably from the sponsor to address their needs, to make sure that they're comfortable with their investment into that project. A lot of opportunities. For over the decade that I've been in the industry, I have never seen something like this before, where you have such an abundance of capital looking for the appropriate place to be put, whether it be with construction financing, term financing, sponsor equity, mezz sponsor equity. All of these things are now available in the market. As long as you have a good project, there are pools of capital that allow you to take advantage of, to be taken advantage of. And so I'd say that what do you expect to see? A lot. What you see as for sponsor equity opportunities is every shade of the rainbow. The key obstacles to true merchant solar are getting tax equity and back leverage comfortable with floating rates. And also you're doing floating rates on an intermittent resource, which is very different than if you're a natural gas plant. You can't determine when the sun shines, hence you could be hypothetically throwing electrons onto the grid that nobody wants. And in those situations, they don't have value. That becomes a bigger challenge when you have, let's call it stronger constraints from your financing partners. They want to feel comfortable that they're going to be getting a certain amount of capital off of these assets. The only way that I see that a true merchant scenario working well is if you actually were doing it solely on sponsor balance sheet. And we saw that back in the day in wind, or we saw it back in the day for 1603 grant scenarios when you didn't have tax equity and people were just willing to put in the rest of the sponsor capital and not utilize leverage. But I think that the current market would not be able to support a true merchant project. Again, with standalone solar, where you don't get to determine when your electrons are being generated or put into the grid, no, it wouldn't logically track. If you added storage to that solar plant, and therefore you could determine when those electrons were sent, there probably becomes a better story that financing counterparties could eventually become comfortable with. It would take a little bit of time, a couple of years probably at least, but that is something where you might be able to get your partners comfortable with to help finance your project.